Welcome to Simple Mind Space, the podcast that helps you master your money and your mind. I'm your host, Steve Van Meter. Today's episode is about a financial crisis that nobody expected. We're going to dive into the U.S. consumer's impact on the commercial real estate market and how it could be the tipping point to the next crisis. Let's start by looking at a Bloomberg article titled, "Landlords Face a $1.5 trillion Commercial Real Estate Maturity Wall." Commercial real estate is believed to be resilient due to the cash flows generated by rent. However, there are some factors that could make the situation worse. The value of buildings has dropped due to higher interest rates, making it harder for landlords to borrow. Additionally, there has been an oversupply of complexes due to cheap and easy money during the pandemic. This oversupply has led to a decrease in demand and lower prices. Many people believe that lower interest rates will solve the problem, but the evidence suggests otherwise. When we look at the net percentage of domestic banks tightening standards for commercial industrial loans, we see that banks are tightening standards even when the Fed cuts rates. This tightening of lending standards leads to less credit creation, which is a dangerous point in a debt-based economy. The yield curve, which shows the difference between short-term and long-term interest rates, further supports the idea that lower interest rates don't necessarily lead to easier financial conditions. Banks make money on the spread between short-term and long-term rates, and when the yield curve is inverted, they don't make as much money. Even though lower interest rates may normalize the yield curve, the amount of interest generated at perpetually lower rates is not enough to cover potential losses. This uncertainty leads to tighter financial conditions. Apartment buildings, which make up about 40% of looming maturities in the commercial real estate market, are at the center of the refinancing wave. Many property owners bought these properties using 3-year floating rate loans during the easy money era. However, these loans are now coming due, and property owners may not have the money to pay them. This puts these properties at risk of delinquency and default. The situation becomes even more concerning when we consider the upcoming end of the student loan leniency period. Many people with student loans are renters, and when they have to start making payments, it will put a strain on their budgets. This could lead to a collapse in discretionary spending and a decrease in demand. Businesses that rely on consumer spending may be forced to cut hours and lay off employees, leading to a further economic downturn. The current state of consumer sentiment also adds to the concern. While there has been a slight rebound in sentiment, consumers still view their personal finances as stretched. The index of news heard about the economy has deteriorated, with many consumers mentioning negative news about unemployment. This negative sentiment can lead to a decrease in consumer spending and a higher unemployment rate. All of these factors point to a looming financial crisis in the commercial real estate market. The $1.5 trillion in debt that is at risk of delinquency and default could have a significant impact on banks, insurers, and investors who are holding this debt. Lower interest rates are not going to solve the problem, and the upcoming end of the student loan leniency period will only make matters worse. In conclusion, the U.S. consumer's impact on the commercial real estate market could be the tipping point to the next financial crisis. The oversupply of complexes, tightening lending standards, and the upcoming end of the student loan leniency period all contribute to the risk of delinquency and default. This will have a significant impact on the economy and could lead to a recession. It's important to be aware of these risks and take steps to protect yourself financially. Thank you for listening to Simple Mind Space. If you enjoyed this episode, please like, share, and subscribe to our podcast.